Next few minutes of your life are going to be really crucial because you're going to finally understand classification of financial assets under IFRS 9. So when we talk about financial assets classification, we have to look at two fundamental tests. One is called the cash flow characteristic test, and the other is called the business model test. So basically we have to pass this particular financial instrument through these two tests to understand what classification would it finally be in. And so first let's look at the cash flow characteristic test. What exactly is the cash flow characteristic? When we talk about the cash flow characteristic test, we first have to look at what kind of cash flows arise as a result of that particular financial asset. So there are two possibilities within this test. The financial asset could either be SPPI, which means it's a solely payment of principal and interest, which means a normal bond which has only a repayment of principal and interest would normally meet this criteria. And then a financial asset can also be a non-SPPI or other than SPPI, which means that there are some variations in the cash flows that are other than normal principal and interest. And there are a lot of examples for these. Right. So strictly, if for example an instrument has principal and interest that accrues over time, then it is an SPPI. But if there's some modification to that particular interest, for example, if the interest rate resets after every 6 months to a 1-year rate, then that would be a modified time value of money, because although the interest is resetting to every 6 months, it's actually resetting not to a 6-monthly rate but to an annual rate. So that would be a modification. Another example is non-recourse arrangement, which means if, for example, in case of default, the lender can only obtain his cash flows to the extent of very specific amount of assets of the borrower, which might not be adequate to cover his principal and interest. So if there are such modifications, then the financial asset would be classified other than SPPI. Otherwise, it would be an SPPI. And if the financial asset is other than SPPI, it will have to be classified as fair value through P&L. But if that financial asset is SPPI, it will have to go through one additional test, which is called business model test. Within the business model test, we have to see how the portfolio within which the asset belongs is managed for the purpose of the business. So the financial asset could be held to collect, which means the purpose of holding the financial asset is to realize all the contractual cash flows from that financial asset. It could be held to collect and sell, which means the portfolio is held to collect contractual cash flows, but if they get good price out of it, they may also sell those financial assets. Examples of portfolios managed or maintained with the objective of held to collect and sell are those that try to maintain a particular yield or a particular risk profile. And so we receive cash flows from those financial assets, but when the price is good or when the criteria is met, we might also sell them. And then we have another business model which is called held to sell, which means any portfolio where we frequently trade our assets is held to sell. So if a financial asset, now look at this, if a financial asset is SPPI and it is held to collect, then such financial asset would be categorized as amortized cost. If that financial asset meets the SPPI criteria and it is held to collect and sell, it will have to be carried at fair value but through OCI. And if that financial asset is held to sell, then it will have to be carried at fair value through profit and loss. Now, if a financial asset is other than SPPI, which means it includes equity instruments, right? The ordinary shares of companies. Now, within equity instruments, there can be different purpose of holding them. which means there could be a reason to hold them, like held to collect or held to collect and sell. And if equity instrument is held to collect or held to collect and sell, then we have the option to designate it as fair value through OCI. Otherwise, if it's the equity instruments are held for trading, then it will have to be carried at fair value through profit or loss as well. Additionally, all of these financial assets where we have the financial asset meeting the SPPI criteria may still be classified as fair value through profit or loss, which means any SPPI asset which is held to collect or any SPPI asset which has to held to collect and sell may also be classified at fair value through profit or loss if they reduce an accounting mismatch. Now, what an accounting mismatch is a story for another day, and that was your summary of classification of financial assets under IFRS 9.